Hi, good afternoon, everyone. Welcome back. Thanks for joining us. I am Siobhan Chapa. I'm the Senior Manager of Business Development Operations here at the RTPark, and I'm your moderator for this panel. My role at the RTPark is primarily working with companies who have made the decision to actually enter into the program and to walk them through the application process and everything that's involved in that. And if you stay tuned with us tomorrow at 3, we'll go a little bit deeper into that process itself. But today we're here to talk about all things tax related. There's many benefits to being in the RTPark program. Peter's gone through a lot of them, the team has gone through a lot of them, but of course the one that most people hear about first and one that people consider to be the most lucrative are the tax incentives. So we have 2 experts with us today. I have Greg next to me, Greg Bryant, who is the founder of the Built Group. And we have Jory Roberts with us from Marjorie Rawls Roberts PC. If you make the decision to enter into the program, you will become very familiar with both of these 2. They work very closely with us. Just very quickly before we get started, don't forget we're going to do a short Q&A at the end, so please put your questions in. There's a lot of information here. A lot of technical information, so if you get a little lost in it or miss a slide or something, don't worry, you can access this presentation. We'll give you access to it afterwards because there's a lot of really important information that these 2 are going to share with you. So I will let Greg and Jory introduce themselves and take the lead on the presentation.
Jory, I'll go first, I guess, since I'm in the room. Hi, I'm Greg Bryant, and I am the managing partner of Built Group, and we are tax counsel to the RTPark. Jory and I have very similar backgrounds. We're both tax attorneys. I'm also a CPA, and our job is to help make sure that the model that's presented to the RTPark is going to work and get you the most benefits. And we work very closely with Jory and other tax attorneys here in the U.S. Virgin Islands. Jory? Marjorie?
I'm Marjorie Roberts, Jory Roberts, as you heard. I am a tax attorney. I've been in the Virgin Islands for 34 years. I was chief counsel for the Bureau of Internal Revenue for about 8 years, then worked as general counsel for a company with incentives in the fund management business, and then have been in private practice, been involved with the RTPark since the start. So we're very excited to address you. I'm actually at my Smith College reunion, my first in-person event in a couple of years. So they were nice enough to give me a classroom to join you from. So I'll go ahead and start the PowerPoint. Okay. So Greg and I have worked carefully to give a PowerPoint. We're going to cover, I think, most of the salient points, but as indicated, there's quite a lot to do in the tax arena. I hope it's not too much information, particularly at 3 o'clock on a Thursday. So I'm going to start with sort of the overview of the Virgin Islands tax system. I think Mr. Mark mentioned we are an unincorporated territory of the United States. We were acquired from Denmark in 1917, I think to protect the Panama Canal, but we were kept when it was given away. We're not covered by U.S. tax treaties, nor any of the other U.S. territories, but we are covered by the treaties of friendship, commerce and navigation, and bilateral investment treaties. So it's always good if you're using the Virgin Islands for an investment that may also involve some other countries to take a look at those. To resolve disputes between the Virgin Islands and the United States, there are a couple of mechanisms. There's a special competent authority procedure whereby you would work with the Bureau of Internal Revenue and the Internal Revenue Service if there were areas of inconsistency. And there's also an implementation agreement that really has the status of a treaty that was entered into shortly after the '86 Tax Act was passed. That's a very helpful document. Let's see. Sorry, I went to, we use the Internal Revenue Code under what's known as the mirror system, and that was started in 1922. And it's harder than it sounds. You look at the Internal Revenue Code and you substitute Virgin Islands for United States where it makes sense. And so, but there are some areas in the regulations where it makes it clear that it doesn't apply, For example, Virgin Islands residents are not subject to the net investment income tax. That's stated in the regulations. So you still always want to take a look at any guidance, and also some of the provisions over the years that have dealt with foreign have not always applied. Dating myself, but foreign sales corporations, you could not have a USVI manufacturer with a US FIS, for example. If you live here, you file one return on all your worldwide income on your income with the Virgin Islands, the Form 1040. You still file your self-employment, your Social Security, gift, and estate with the IRS, but income is filed here. If you live in the United States, but you have VI income, there's a special procedure for allocating. So it doesn't increase your tax, but you do pay tax to the Virgin Islands on your Virgin Islands income. You're going to hear more from Greg about the fact that the Virgin Islands is foreign to the US for corporate tax purposes, particularly the rules for controlled foreign corporations, passive foreign investment companies, foreign personal holding companies, and as you'll hear in particular, the global intangible low tax income, which is much broader than intangible in practice. And finally, if you're a Virgin Islands corporation, you file Form 1120 with the Virgin Islands. And if you are a US corporation doing business down here, you file an 1120F. We don't have our own corporate or income tax returns. Some people write Virgin Islands at the top, but that's not necessary. And then I'm going to talk a little bit, it's sort of an overview of our incentives. The Virgin Islands has language in the Internal Revenue Code. So Congress has blessed this to have incentive programs. And the current incentives are under 934, which was amended by the Internal Revenue Code of 1986, and then further by the Jobs Act of 2004. And it permits the Virgin Islands to reduce or remit income on income that's Virgin Islands sourced or effectively connected. And those are both defined terms. The Virgin Islands, under these umbrella, offers different incentive programs to different types of business. And we're focusing on the Research and Technology Park, which has been in force for about 20 years and is really growing, a very exciting addition to our incentive programs, but we'll list a few others towards the end. Incentive programs have been in place for over 60 years, although initially they were much more on heavy duty manufacturing and hotels. And with that, we'll go into structuring business, and Greg will take the lead here. Thanks.
So, of all the regimes, I do work with tax regimes around the world. This is one of the best. And it requires you to be a resident, and it also requires your income to be sourced here. So you have to be a resident. That's different than being domiciled. And that residency is determined based on the number of days you're here. Domicile is determined based on your specific intent. And an example would be California asserts domicile over people who leave if they keep their driver's license and own property in the state even after they leave. So you have to be here 183 days, but 30 of those days can be for travel in other places as long as it's not in the United States. And Jury will go into that a little bit more in a little while. But the planning is very important because not every business model works in this regime. Not only do you have to be resident, but you have to have income that is sourced to the U.S. Virgin Islands or effectively connected to the U.S. Virgin Islands. And source is a tax term that really derives its meaning from the Internal Revenue Code. And we're going to go into that in more detail in a few moments. Additionally, the Tax Cut and Job Act, which came in December 22nd, 2017, created a great expansion of the U.S. anti-deferral rules that exist under what's called Subpart F. That's the section of the Internal Revenue Code. And in that expansion, they added something that's called GILTI. And it's a catchy acronym. It stands for Global Intangible Low Taxed Income. And what's interesting about the acronym is the taxation has nothing to do with global intangible low taxed income. And we'll talk a little bit more about what it does reach. But in order to be subject to GILTI, your company, and the reason this is important is because it restricts your ability to have U.S. resident shareholders. If you have U.S. resident shareholders and you have enough that more than 50% of the company is owned by U.S. residents, you would be subject to this GILTI rule, because this company in the U.S. Virgin Islands would be considered a controlled foreign corporation, and that has brackets around it. But the rules of Subpart F are extremely form specific, and they only count owners, U.S.-based owners, who own 10% or more. So if you have 11 owners who own 9%, nobody owns more than 10%. Under Subpart F, you don't count any of them. So sometimes the 9% rule is a good rule of thumb, but you can have an owner in the U.S. who owns up to 49%, and as long as they're not related to any other shareholder residing in the U.S. Virgin Islands, you still don't have a CFC. You still do not have a controlled foreign corporation. And so structuring becomes incredibly important when you start bringing in investors who might not be resident in the U.S. Virgin Islands. Additionally, under these rules, you can elect to, if you do have a GILTI problem, you can make certain tax planning elections that will significantly reduce your tax burden and get you a 10.5% tax rate and allow you to use tax credits. So sometimes, you know, if you know this problem's in front of you, you get a tax attorney or a good CPA and you do planning, you can actually mitigate the risk and bring it down a lot. Most of the structures, however, we find in the RTPark are resident-owned and they're LLCs, so they're treated as partnerships or as disregarded entities, and then the flow-through goes right up to the resident who lives here in the U.S. Virgin Islands. That structure gets you between a 2.4 to 3.7% tax rate. That's a pretty low tax rate, and there are few places in the world, in fact, as a U.S. citizen, there are only maybe one or two other places where you could get that tax rate without having to give up your U.S. citizenship. And this is very important. You can live here and get this benefit if you meet the qualifications. Let's go to the next slide, Jerry. So what is GILTI? Well, GILTI is nothing to do with global intangible low tax income. It actually is all the income that is not in the United States that does not relate to a 10% return on depreciable assets. If you don't have an asset-rich business, all of your income outside the United States is GILTI. It's that simple. If you're a CFC. You can, however, do this election called a 962 election that will allow you to get a 10.5% tax rate even as an individual. However, when you bring the dividends back to the United States, there would be an additional 20% tax. So you don't get the benefit of the PTI that a corporation would get. But we found a lot of companies have converted to C Corps because of this rule. And for a corporation, and if you make the election under 962, you really get an outcome that isn't terrible. It's about a 10.5% tax rate. And the reason you get there is because you get a 50% deduction against the 21% rate. But under the rules, you only take a 20% reduction on your tax credits. So you actually get to hype your credits, and that 10.5% might come down to like 6.5% because you can use tax credits. Let's flip the slide, Jerry. So in order to get the benefits aligned to your U.S. Virgin Island company, you need to have U.S. Virgin Island sourced income or what's called effectively connected income. And effectively connected income is income that is associated with a trade or business located here. It's not an election you can make, it's a factually determined thing. And I'll give you a good example that I use. If I mow my grass and take care of my yard, I am not in the landscaping trade or business. I am mowing my grass. For me to be in the business of landscaping, I would need to mow my neighbor's grass and get paid for it and have a profit motive. That is a trade or business, and if I have income related to that, it is effectively connected to that trade or business. So those are the facts you would need. The reason that's important is because When you are in the business of providing brokerage services and other things to third parties, you are in the brokerage business. That is a third-party business. But if you are trading on your own account, you may not be in a trader business, because that is the same, in my analogy, as mowing your own lawn. Now, there are certain family businesses that I think could qualify, but we have to look at the facts very carefully. So generally speaking, you have to be in a business of representing other people, and then the profits that are related to that would be considered effectively connected. And it's important, you know, especially for certain businesses that might have capital gains or other types of income, that if you look at the sourcing rules, might not be considered to be aligned around the U.S. Virgin Islands. There has been some guidance on the effectively connected rules, and it came out in the regulations to another section, and it also is in some guidelines that came out under the IRS. And a good example would be in computer software. If you license intangible property to somebody, it's sourced to where that property is used. So if you're in the Virgin Islands and you license software to somebody in France, that's considered to be French-sourced income. But if you sell the software and you're actively in the business of doing the software, that changes the rule. It becomes effectively connected to the U.S. Virgin Islands. And there's some guidance on that, and I think you can, by analogy, apply that to a lot of other businesses. Jury? Thank you. So here's the one, and this is a table, really. We're going to probably go through this a little quickly because it's technical, but it's a really good reference tool. But I think it's important to note that a lot of the models that we see people use are service-based models, because services are sourced to where they are performed. And if the services are performed in the Virgin Islands, U.S. Virgin Islands, they are sourced to here. So as opposed to if the services are performed in the U.S. Virgin Islands and maybe also in Europe and in Asia, in that case, services would be sourced partially to here and then partially somewhere else. Let me give you an example. If you lend money from the Virgin Islands to the United States, that is considered to be sourced to where the borrower is, which would be the United States. You wouldn't get any benefit here in the Virgin Islands because it's not sourced here. But if you provide underwriting services to people in the United States, to make loans to people in the United States, that service is considered to be performed here. And now that profit is sourced to the Virgin Islands. So service-based models are very effective, and sometimes you have to convert your business model into a service. Other models that we find a lot of times have to do with inventory, either manufactured here and sold or bought somewhere else and sold somewhere else, not here in the Virgin Islands. Those rules generally will allocate the income from that sale to partially where title was transferred if you did not manufacture it yourself. And if you make it yourself, it'll be partially sourced to where it's manufactured and partially to where it's sold. So those rules tend to be a little technical. And it can also apply to the sale of other property. The general rule is the sale of any property that's not inventory would be sourced to where you live. So if you sell and you live in the U.S. Virgin Islands, it would be sourced here. But I'll tell you, there are some limitations on that. There are anti-abuse rules that will prevent you from moving here to unload your portfolio and then move back to the United States. And there are quite a few of them, in fact, and Jury is an expert on those, and I know she can guide you through that. The rest are, I don't know, Jury, if there's any one on this next slide that's worth focusing on that might be interesting, because I think I already spoke to interest income. I mean, rental income could be interesting. We do see some models where people have leasing as part of their model, and they will lease out of the Virgin Islands. Go ahead, Jury.
Well, I do think what's interesting about interest dividends royalties is that they fall under the definition of effectively connected if they're not paid by U.S. parties. So the Virgin Islands is a very good place for businesses that are, have a client base or an investment base outside of just the 50 states, the United States. Incidentally, that is not something that Puerto Rico has. They do not have the concept of effectively connected, but we do. So I have seen people, do investments and so forth on a global basis from the Virgin Islands, often in knowledge-based businesses. So that's, I think, something that's worth looking into for many people.
And you made a good point of pointing out we have to have a business that is also taking care of other clients, and it can transform the sourcing from being outside the Virgin Islands to inside. Thank you, Drew. I think there's more to say on this one. Thanks.
And I'll jump in a little bit.
Sure.
Of course, you've been hearing all day about RTPark, and the development and growth of the technology sector is key to it. There are targeted businesses that the RTPark, and you've probably heard a bit about this today, but just to quickly go through it, information technology is a very important area. And again, we just talked about software sourcing. Financial technology in general is also an exciting area, and we've had some companies here in that area. I think there's a real focus on healthcare and life sciences and getting businesses in that area. Also, the university has a simulation center, so there are a lot of synergies between the university and the RTPark in that area. Sustainable development is also exciting. I see a lot of people who are interested in sometimes technology sources involving the ocean, like ocean thermal technology. We also have a light agribusiness here, so that's a really good development. And then business process outsourcing is great. That generally gives rise to fee income, and because of all the technological resources we've already heard about, that's a natural fit with the RTPark as well.
And I think one of the things first of all, it has to be knowledge-based. So it has to be in the IT, the financial technology. It has to generally require higher degrees of education. Most of these businesses, too, can serve markets well beyond the U.S. Virgin Islands, and that's really important for what this program's about. It's really bringing in, the ability to export services and knowledge to the United States and the rest of the world from here. This isn't set up to be just for this marketplace. And these, all these technologies really serve, 24/7 around the world, and we have many clients who are in 15, 20 countries that are in these industries. So if you have a business that, it can serve markets without being physically present, this is a great place to be. And you won't find a better tax regime than you will here. And you don't have to give up your passport to get it. Let's go to the next slide, and I'll explain what some of these benefits are. So that's already up. So you get so under Section 934B, which Jury referred to earlier, the U.S. Virgin Islands is allowed to give you a rebate or a credit or reduction of tax if you are resident and the income is sourced or effectively connected to that residency. Well, here's what you get at the RTPark, a 90% deduction against your income. So what does that mean? Well, if you're a corporation, that means your effective tax rate, there's a surtax, so it would be 2.3%. And then you can take the dividend out and you get an additional 90% deduction. So and if you're an LLC, your tax rate's around 3.4%. And that's it, in your pocket. There are very few tax regimes that'll get you that. You get an exemption from local taxes like import taxes. There's a whole bunch of taxes you get an exemption from. The gross receipts tax. You get reduced withholding taxes on dividends and interest and royalty payments to people who are investors and who are not in the U.S. Virgin Islands and not U.S. resident. Actually, you don't have dividends to the U.S. resident either. And there's no withholding taxes to U.S. persons. So you get a reduced withholding tax to non-U.S. persons, and there's no withholding tax to U.S. persons.
And if I just might quickly interject, if you go to the RTPark website, it's UVIRTPark.net, and you go to the information tab and downloadable documents, there is an actual document on our website that lists the full extent of the tax incentives. There's about 10 different ones, so you can access that complete list on the website. Again, it's UVIRTPark.net.
And this all happens because you become what's called a protected cell. And you fall into a regime that's underneath the RTPark and tied to the the university here. And I don't know if you want to describe that protected cell concept more than that, but that's the way I understand it. Okay, that's fine. And then you have to ultimately pay some fees and other things in lieu of to get this 90% deduction, but it's definitely worth it, especially if you have a business that, you know, is generating good profit.
Mm-hmm. And if you check in with us tomorrow at 3 o'clock, we'll be going through the full process of what you need to do as a client to access these benefits, what that process looks like, what the fees are, and that kind of thing. So that's tomorrow at 3 in next steps with the RTPark.
And that's what you'll find with the RTPark. I've been working with them for a year, and I can tell you that they will do more than just get you a ruling. They will guide you all the way through. They really want to see your business succeed. I can honestly tell you. Hey, jury, I think we can go to the next slide.
Great. And so I mentioned the outset that the folks technology part, but I know there's some service providers on this call, and so it's always important to let people know that under the umbrella of Section 934, there are some other economic development programs as well. Sometimes they can work in coordination too with the RTPark. We have the Economic Development Program run by the Economic Development Authority that works closely as well with the park, but it oversees traditional programs such as all the hotels, manufacturing such as the boat manufacturing on St. Croix and so forth. We have the STARS program, or Sustainable Tourism through Art-Based Revenue Stream, to bring more music and film businesses to the Virgin Islands. And we heard, how those have been very important. Shawshank Redemption was filmed here, but I laughed, the Virgin Islands were always the last scene. We were the last scene in Trading Places. We were the best scene in the Benjamin Button movie. We're always the place that people, really want to go to or end up. With Enterprise Zone, that program is to provide incentives for the downtown Frederiksted, Christiansted, and Charlotte Amalia to encourage investment with different types of tax breaks. There are two different programs, but to help revitalize our very historic times. A lot of Danish names there still from our Danish history. Tax incremental financing is a financing source, as is the Hotel Development Act. Those are run by the Economic Development Authority. We have exempt companies that need to be foreign owned, or exempt insurers that are very beneficial. I noticed we also have international banking facilities that are run by the Lieutenant Governor's Office and the Economic Development Authority. We have benefits for farmers and fishermen if that's your primary business. We have benefits for renewable energy, which are exciting. Qualified opportunity zones, which are the federal program that lets you defer and get a break on your capital gains. And then we didn't mention on the slide, but our rum manufacturers and also our refinery actually have their own, in effect, tax incentives that are approved separately by the legislature. So that is an option when you have a very sort of unique set of facts and needs.
And there are lots of opportunity zones. U.S. Virgin Islands, I looked at St. Croix, and if you look at an opportunity zone map, it lights up. I mean, there's a lot of opportunity zones there.
And you can combine opportunity zone with the RTPark because, as was just said, they're in both St. Thomas and St. Croix. So that's a real opportunity. And even though we talked about, it's better if you are resident here, you might be able to combine a company where someone invests under 10% and gets the deferral on their capital gain and, gets the benefit of investing in, a very exciting opportunity. So we're talking in general, but each case has its own unique factors. So it's important to look at it. And we talked about sourcing, but we've also talked about residency as a critical element to being able to maximize your benefits in the Virgin Islands. And I would say the bulk of the people of the businesses are owned, at least in part, by people who meet the bona fide resident requirements. I won't go into all the detail. When the Congress and the IRS put out the residency rules, you have to meet a physical presence test, And there are 5 alternative ways to meet it, and you can meet different tests in different years. Most people think of the 183-day test, and that's probably the one that most people meet, where you have to be here all or part of 183 days, with some exceptions on the next slide. But a lot of clients also, if you're in the United States mainland, 90 days or fewer, I'm going to still tell you to spend a lot of time here, but you're not wedded to the 183-day test. And also, if you don't have a home in the States, you don't have family in the States, and you don't vote in the States, then you don't have to count days at all. Again, I tell you to still, you need to spend time here, but there's not a specific day test. I'll go on to the next one, but we're glad to talk about any of the 5. I mentioned that some days aren't actually in the Virgin Islands that count. In 2015, the IRS gave people the ability to use 30 days spent abroad or as days towards the Virgin Islands counting. But you have to be in the Virgin Islands more than the US. So to maximize it, you'd actually, and I used an example, be in the Virgin Islands 153 days, in the US 152, and then you could be abroad 60 days, 30 of which would count as VI days. These are reliance regs, so they haven't been finalized, but you can rely on them. There are also other exceptions, medical days. If you, a spouse, a child, or a parent is hospitalized for at least 1 day, and the doctor tells you you need to be there for whatever period of time. I've had people who've broken legs abroad and been told they couldn't fly for several months due to concerns about, say, blood clots. So that is really up to what the physician feels is in your best interest. Declare disasters. We've had, after Irma and Maria, we basically got residency days into the following end of May because of the severe damage of back-to-back Category 5. Full-time students. If someone is studying outside the Virgin Islands on a full-time basis, those days count as Virgin Islands days if they were a resident before they undertook their studies. Certain athletic participation in charitable sports events represents the VI, and of course, government officials traveling for business are not losing their VI days. Finally, I mentioned the physical presence because that's really the test that people seem more interested in. But you also have to have a tax home and a closer connection test. Tax home means that this is your principal place of business, and there's some more specific procedures, but it's got to this has got to be your principal place of business where you earn the most money, spend the most time, and really list as your principal place of business. Closer connection is such factors as voting, driver's license, home for your full-time use, personal effects, banking activities, financial records, and sort of just, again, where you do what you do when it's your principal place of business. If you give to the Boy Scouts, you give to the Boy Scouts in the Virgin Islands, and so forth. You do have to file a form with the IRS in 8898 when you move to the VI and when you move away from the VI, assuming you make more than $75,000 in the years of move. And that is filed with the IRS, not with the Virgin Islands. And also, we recommend that you do a regular change of address form, both with the Virgin Islands and the IRS, as well as the state, when you move to and from the territory. And I think that's our last slide. A few quick facts I wanted to mention that I realized we didn't include. The Virgin Islands is part of the United States for SEC purposes, and we're part of the United States for ERISA Department of Labor purposes. We are exempt from the Jones Act so that you can not use U.S. That can be important for the RTPark. I don't know if it's covered by another slide, but when you move, ship goods to and from the Virgin Islands. And we're also outside the customs zone. So the customs law that might be referenced is actually a locally enacted customs law. It's enforced by the U.S. Customs, but that's really part of an arrangement so that, for some other services. But sometimes you can manufacture in the Virgin Islands, you can have items brought in, and you can do high-tech manufacturing, knowledge-based manufacturing, and then enter the U.S. market as a made in the USA product, but free of additional customs duties when it enters the US. So if you're interested in knowledge-based manufacturing, that's also something to think about. Greg, anything to add?
Sorry, can I ask a question about that last slide? Just to clarify this, if I live here and my family stays in the United States and my kids are in school in the United States, don't I have a problem?
It is one of the enumerated factors. I actually testified on the regs in 2006, and a lot of the initial examples made it sound like where your family lived was determinative. But when they issued the final regs, they made it very clear that that is a factor, but it is not determinative. And there's a case like the Jones case where the spouses had different residents, and that was upheld. Generally, I always think that many people will look at the schools in the Virgin Islands, or if they have children, and in most cases will enroll them. I had a case once where a son was in high school and he was a D1, a football player, and we have football, but we don't have any goalposts in the Virgin Islands. So, I think if there are unique factors, that might be athletic or academic that would result in not moving your family, but it's a factor to look at. And I always tell people, look at it and with an open mind.
It definitely needs extra care if that's the fact. Well, here's the question.
Questions? Thank you, Jory and Greg. That was a lot of information. As I said, the slides will be available if you want them. So if you didn't catch all of it, we have it available for you. I'm going to go, we only have a couple minutes, so I'm just going to go through these questions really quick. If I don't, oh, yes, contact. Mm-hmm. Yeah. If I don't answer your question here, I will respond to you on the platform. I will start with the simple ones. What's the difference between the benefits under the RTPark and the EDA? The benefits are exactly the same. The VI code lays out the benefits, and they are exactly the same benefits under both programs. The EDA has a couple different things, but in terms of programs, like the hotel tax incentives and stuff like that, but the straight tax incentives are the same for both programs. Are the stipulations to receive tax incentives monitored to ensure the businesses are actually adhering? Absolutely. So the RTPark has its own compliance department. You get your park tenant agreement at the end of the process, your application process, and in your park tenant agreement, all of your requirements are laid out, and we 100% monitor it through our compliance department. You're also, of course, always subject to an IRS audit. Hopefully you never get it, but you're better off, adhering to what you're supposed to do in terms of the sourcing and that kind of thing, because that is controlled through the IRS itself. So you don't want to go through that. If an entity with tax benefits spins out a division as a separate company, does that new company enjoy the same tax benefits automatically, or does the new entity have to apply for benefits on its own? Jory, I'm going to let you take that one. Did you get that? So if an entity with benefits sets up a separate entity under it, does that entity automatically get benefits, or do they have to apply separately?
There's a note under the RTPark. There's a notification requirement. Often in the application process, if we envision, for example, having wholly owned limited liability companies underneath the sort of holding company, that would be part of the application process and would be approved. The Virgin Islands does not have series LLC legislation, so sometimes we replicate it by having a series of separate LLCs, all wholly owned under a holding company. However, if you're operational and then you decided, you wanted to set up another entity, and you hadn't sort of covered up front, it would be a notification requirement, assuming that it was a business that was part of what had been approved in your park tenant agreement. If you're expanding into other areas, then, that would be a situation where it would be whether that really fell within your park tenant. It could be approved, but it might lead to some additional, changes or review of your initial terms. Or I've had clients who've done multiple RTPark. So that'd be the other thing is if you were doing a new entity, but it was really enough of a separate business, you'd probably do a separate application in that case. And that's been a pretty painless process as well.
So I think we're right out of time. I want to answer one more question very quickly. I think it's exciting. It's not tax related, but I want to answer it anyway. Is there a push for more minority and women-owned businesses? 100%. It's a priority for our business attraction team. And I want to say the RTPark just recently, last month, approved our very first minority woman-owned business. So we're super excited to have her in the program, and the business attraction team 100% makes this a priority. It's very important to us. So with that being said, thank you both so much for taking the time.
Thank you.
Thank you guys for sticking it out with us.
Thank you, Jory.
We're going to go into... Yeah. So we're going to go into our last break of the day,
Great
and
job.
then stay tuned for our last panel, which is telecom in the 21st century. So thanks, everyone.